Hello, everybody. My name's Di. I'm one of the Money Max guys. And in this series, we are going to learn how to bank like a bank. This is critical information that we absolutely must know, not only to survive, but to thrive in today's financial market. We're going to talk about 8 different banking products and principles and how they come together to create the most effective and aggressive debt to wealth program on the market today. We're going to talk about closed-ended loans, mortgage amortization, interest cancellation, open-ended loans and lines of credit, offset accounts, float and leverage, interest accumulation, and strategic debt payoff. And we're going to see how combining these 8 products and principles, we can literally crush and destroy any debt in record time. So let's get started. What do we know about closed-end loans? Well, first of all, they only allow money to go one way. You can make payments in, but you can't take any withdrawals out. And they require, at minimum, a full scheduled payment. They're driven by an amortization schedule, which means that money applied today, it does not affect your interest charges until the following month because they calculate interest charges off of the previous month-end balance. What did I just describe there? Yeah, that's our mortgages, our cars, our boats, our ATVs, anything that has a start date and an end date, that is a closed-ended loan. So let's move on to our next banking principle, mortgage amortization. Throughout the series, we're going to be referring to a $400,000 loan with a 6% rate amortized over 30 years. The payment on said loan is $2,398.20. And if we look at the breakdown in month number 1, we see $398.20 going towards principal and $2,000 going towards interest. That is not 6% on any planet. That is 83% of our first payment going towards interest. Now, the good news is every single time we make a payment, a little bit more goes towards principal, meaning a little bit less goes towards interest. So if we look at month number 2, I wasn't kidding when I said a little bit. It's less than a $2 difference. Is it any wonder that it takes this type of loan 30 years to pay off? Let's take this out to the end of year number 1. We've now paid over $28,000 on said loan, and our equity position is just under $5,000. If we take this out to year number 5, we have now paid over $143,000, and the bank has given us credit for $27,782, meaning over $116,000 went where? To interest. And what did that interest buy us? Did we get a couple extra bedrooms added onto our house? Did we get a few extra acres out back? No, we got absolutely nothing because interest, that's another name for bank profit. This did your family no more good than you taking $116,000, lighting it on fire, and watching it burn. Friends, how many hours do you work to earn $116,000? How many hours do you spend away from your family? How many hours do you sit in traffic just to light that money on fire and watch it burn? And the crazy thing is, this is where we've all been conditioned to refinance and start the vicious cycle all over again. Now, if you think that's an exaggeration, when you go to work tomorrow, ask your colleagues, ask your friends, hey, how many years do you have left to go on your mortgage? You're going to hear 27, 29, 28, 30. I just refinanced. Very seldom do you come across somebody who owes less than 25 years on their mortgage. But let's take this out to year 10. We've now paid over $287,000 on this mortgage, and our equity position is under $66,000. If we take this out to year 21, this is a very special year in our mortgage because we have now paid over $604,000 on a $400,000 loan. But the good news is we're at the halfway point. We have just over $200,000 in equity and we owe just under $200,000. How 21 is half of 30, I'll never know. But that's just the absurdity of bankers' math. And if we make every single payment on time on a $400,000 mortgage with a 6% rate over 30 years, we will pay back $863,354. That is not 6%. It's 116% more than what we borrowed. And I call that legalized theft. It's legal. We signed the documents. It's theft. We had no idea what we were signing. And it's really not our fault. Nobody's ever taught us the difference between 6% APR and 116% total interest percentage. And the banks sell us on APR, but they charge us on tip. And as Albert Einstein says, those who understand interest, they're destined to earn it. Those who don't, they're doomed to pay it. Who do you think understands interest in this scenario? Don't you think it's time we get smart about our own money? Now, I know what some of you are thinking. You're thinking, whoa, I dodged that bullet, Di, because I refinanced during the pandemic. I don't have a 6% rate. I've got a 3, a 2, a 4% rate. Friends, if you take anything away from this series, I want it to be this one thing. Rate does not matter. Write it big, write it bold, underline it, give it an exclamation point, because rate doesn't matter. It's the type of product you are using and how that rate is calculated. And I'll prove that to you mathematically throughout this series. So let's take a look at the same $400,000 loan, but instead of 6%, let's give it 4.5%. Year number 1, we're still paying over 73% interest. Year number 5, we're still paying over 68%. I'm one of those people who refinanced during the pandemic. I have a historically low rate of 3%. But when I look at my closing disclosure, my loan estimate, it shows me that if I make every payment on time, I'm paying back over 51.8% more than what I borrowed. Now, don't be terribly depressed, because in our next episode, we're going to start learning how to beat the bank at their own game.